The Dentalpreneur Podcast. Okay, doctor, it's time to put down that handpiece. You're listening to the show dedicated to helping dentists get their lives back. It's time to decrease your stress, increase your profitability, and regain your passion. Now introducing your host, Dr. Mark Costas.
Hello, everyone. Welcome to another episode of the Dentalpreneur Podcast. I'm your host, Dr. Mark Costas. Hey, guys. For all of you M&A nerds, for all of you people that are considering someday selling your dental practice, you guys are in for a treat. And incidentally, transition happens for every single dentist, whether or not you want to admit it or not, whether that equals transition to closing the doors or transition to handing the keys over to your son or daughter that happens to get into dentistry at some point, or transition to your associates, or selling to a private equity-backed DSO. Transition will happen at some point in your career. So it's good to kind of know the nuance to how to do that successfully. Welcoming back to the podcast, I want to say hi to Brannon Moncrief. He has over 20 years of dental experience. As a banker, broker, and sell-side advisor for the past 14 years, Brannon has served as the principal and CEO of McLerran and Associates, which specializes in providing sell-side advisory to large practice owners seeking a DSO affiliation or private equity partner. All right, buddy. I got to tell you guys that Brannon and I have some very, very great conversations. He's taught me so much about kind of this M&A private equity world. And that is, he's a huge part of the reason that I can walk into a meeting with some very high level people and not sound like a complete noob. But I probably know just enough to get myself into trouble some days. But you do have a depth of knowledge because of your 14-year experience. So welcome back to the podcast, Brandon. How you doing, buddy?
Jen, good to see you. Always happy to be here. Happy New Year. Even though it's almost February, time is just flying by.
It was weird. Like yesterday, I was telling my wife after my long day, for whatever reason, I got like 7 texts from random people that were unaffiliated that said, Happy New Year. Just wanted to check in. And I'm like, wait, isn't it the 19th of January right now? But just a cluster of people, for whatever reason, wished me a Happy New Year yesterday, 3 weeks into the new year.
Everybody checked out for a few weeks, which is kind of nice, right? I've noticed that over the past 5 years, it seems like come the back half of December, everything slows down, especially in our world, the M&A world. Not a lot gets done, at the end of the year, unless obviously there's a threat for capital gains tax to increase dramatically like there was a few years ago.
Yep.
But yeah, it's like the lights don't turn back on until maybe the second week of January. And now we're crazy busy as a result of being a little slow for a few weeks.
Yeah, it is fun to see the wheels start slowly churning again. I just sat down and did my my travel schedule with my kind of my executive team to see when I was going to be out of town to arrange travel and all that. And it's going to be another very, very, very busy year as far as travel. And there's a lot of conferences and there's a lot of interesting things happening in the marketplace. But off air, you and I were talking about just a little bit about how our year went for 2025. And you had alluded to the fact that this was probably one of your best years yet in a very long and storied career. Why do you think that 2025 was so good for you, considering some of the headwinds that we were facing with a new administration, some of the elevated interest rates that haven't been resolved yet, and just some of the uncertainty in the M&A market that really, really kind of plagued us to the tail end of 2024 and all through 2025. Why do you think you guys had such a good year in the transition kind of game?
Last year was a high watermark for our firm. I don't necessarily think that is a reflection of M&A activity in the dental space. It certainly cooled from its peak in let's say the back half of 21 through the front half of 2023. I think it's a product of the fact that people are still looking to pursue DSO affiliations and private equity partnerships and practice sales for one reason or the other. As you said, I mean, it's inevitable. If you own a practice, eventually you're going to go through a transition. I think they're approaching it in a little bit more of a pragmatic manner than before. Back in 2022, for example, when valuations were at their peak, when the macroeconomic environment was incredibly favorable from an interest rate and capital market perspective. I mean, it was relatively easy for a doctor to trip over an 8x, multiple on their single site office. But fast forward to today, with the way the capital markets have been and an elevated interest rate environment, I think you've got to be a lot more buttoned up in your approach to taking your practice to market. Not all DSOs are created equal. Some of them have done very, very well and outperformed their financial projections, while others have completely failed. So I think rather than trying to navigate these waters on your own, doctors have gotten wise to the fact that who you pick as your partner, what deal structure you accept, is as important or more important than the initial valuation. And you've got to date around. You need optionality. You need to create competition and leverage for your practice. And you need to make sure you control the narrative regarding EBITDA. And that's really where we come into play to make sure that, one, we're taking a pragmatic approach to evaluating the why, how the business is engineered, is now the right time to sell, and what are you looking for in a partner? What gets you excited and gets you out of bed in the morning, and what keeps you up at night, and unpacking that why and making sure that we marry that with what the market has available to get a good outcome, both, emotionally and financially, and making sure that, you're not just celebrating on the closing day, but also happy 2-3 years later with that partnership.
Yeah. Wow. Based on that just opening statement there, I have a ton of follow-up questions, but the first one would be, it feels to me, and you and I have actually talked about this before, it feels to me that the ideal buyer is skewing a little bit younger than it used to. The ideal target obviously is skewing younger than it used to for private equity-backed DSOs. But people seem to be selling their very, very profitable practices younger in their career than they used to before. First and foremost, do you have kind of a peak time when you think it's the optimal time in a practice owner's trajectory to take some chips off the table? I know you're probably going to say it depends on their personal why and their personal situation, but what have you seen as far as good timing and the reasons why?
It's a great question. I mean, there has definitely been a change in the marketplace in regards to the average age of our client. Up until about 5 years ago, average age of our clients was probably, mid 50s, and now it's mid to late 40s. Oh. I think that's a product of the fact that the younger generation of doctors are more entrepreneurial and have built larger businesses earlier in their career than their predecessors. And many of them have families and have lost out on spending time with their kids because they've been focused on building a productive and valuable business. Along with that, the larger the business, the more problems, right? The more people to manage, the more stress from an operational perspective. And I think COVID in particular made a lot of people take a step back and think about their priorities. And for many people, they wanted more balance in their life. Therefore, they're looking to pursue a sale earlier in their career than they may have planned or their predecessors did. I think that's also married with the fact that deal structures have evolved to kind of meet doctors, younger doctors, at that place in their life. DSOs can provide that operational support and infrastructure that those doctors crave so that they can get better balance in their personal and work life. But they're also offering joint venture, practice level equity on a go-forward basis. So a lot of young doctors are scared to sell the practice, especially in a HoldCo scenario where they no longer have practice level equity, no longer receive any type of EBITDA distributions, because their chairside income is not going to be sufficient enough to cover their personal lifestyle and burn rate. The joint venture structure solves for that. Because if you have practice level equity, you not only have your chairside compensation, but you also receive your pro rata share of distributions. For those reasons, it's become a really, really good option for a younger doctor that wants to monetize a majority interest of their business at an elevated multiple and valuation, but hang on to a substantial amount of practice level equity and participate on a go-forward basis in the growth of the business via the EBITDA distributions, as well as the increase in the value of their remaining equity in the business. So I think it's kind of been a perfect storm in the sense that you've got younger entrepreneurial dentists that have built these large practices that want to take some chips off the table, want to de-risk, want to monetize the business and diversify their wealth and get help from an operational administrative perspective and get better work-life balance, in combination with private equity and DSOs have gotten wise to the fact that you need alignment with your doctor partners at the practice level, not just at the HoldCo level. So that's why the hybrid and joint venture deal structure has gotten more popular. It works for both parties. It's a great fit for younger doctors that have a longer runway to exit, and PE loves it because it creates alignment at the practice level and ensures that the stakeholders keep their foot on the gas and continue to lean in and grow the business.
What is more prevalent in the marketplace right now? Which model is more prevalent? The HoldCo, complete HoldCo, or the JV model?
It's probably 50-50.
Okay.
The HoldCo buyers that historically used a pure HoldCo structure, meaning that they were going to buy 100% of your practice, you were going to receive, let's say, 60 or 70% cash at close, and the remainder of the valuation was going to be allocated to HoldCo level stock in the parent company of the DSO. Mm-hmm. There's very few pure HoldCo models out there today because, again, we're far enough in the evolution of the consolidation of our industry that those pure HoldCo models have realized some pain in regards to the fact that they don't have alignment with their doctor partners at the practice level. And it can create kind of a free rider problem where the doc takes their foot off the gas in their practice because they're counting on all the other partners in which they own small equity in each of their practices to keep their foot on the gas. So they've realized that they have to create alignment at the practice level. And the way to do that is either to introduce some form of joint venture, retain practice level equity, or some type of earnout where the doctor has to keep their foot on the gas at the practice level in order to realize a portion of the valuation over time. So you see very few, if any, pure HoldCo models out there today. The market has moved more towards a joint venture model or a hybrid model where the equity component is bifurcated into, maybe half of it's HoldCo equity, half of it is joint venture practice level equity. So one of the things to talk about a little bit today is the fact that the market has evolved dramatically over the past couple of years, not just because of the change in the macroeconomic environment, not just because the capital markets have been tighter and interest rates have been elevated. We're now kind of halfway through the consolidation of our industry. So there's been enough M&A activity, there's been enough acquisitions that DSOs know what they're good at and what they're not good at. They know where they can be successful and provide value and, have an accretive acquisition over time versus where they've, stubbed their toe or, broke their ankle, hopefully not lost a limb. So they're being more selective about the types of practices that they're going after.
Yeah, for sure.
Because they know what they're good at and they know what they're not good at. And they look at risk through a different lens because they now have perspective. As opposed to 5 years ago when many of them were just getting started, maybe they had only bought 10 or 20 offices. Well, fast forward to today, they've bought 200 offices, much more perspective about how to evaluate risk and how to structure deals. And that's one of the big reasons why you've seen deal structures evolve over the past 2 years and valuations evolve as well.
Yeah. Okay. So I'll take this a couple points at a time. The first one is it's very interesting to hear the difference between the alignment, as you put it, in the HoldCo model versus the JV model. And to me, if I think about it, it's almost like a socialist model versus a capitalistic model, right? So like you have a tranche of these practices, and if it's 100% HoldCo, if you do take your foot off the gas and and decrease the value of that practice or the overall EBITDA or the overall top line revenue, you don't feel the pain as much as you would if you were in a JV model, right? Because you're a part of 100, 200, 100, or 200 practices, and the collective performance of all of those practices is what's going to increase the value of your stock. So you don't feel the pain directly. So you take your foot off the gas and you're like, well, I'm sure that, somebody else over there is killing it and making up for my laziness or whatever, for my lack of performance, probably better. HoldCo, on the other hand, you have this opportunity to still, get 30 to 40% of the EBITDA of the practice minus a management fee. And so as you produce more, you directly see the benefits of that. And as you produce less, you directly see the benefits of that. So that's capitalism. Socialism is everybody puts their efforts together. Everybody is distributed out the same equal amount. So that's why socialism doesn't work, by the way. And capitalism does. So that is one thing. And I love the way that you explain that. It makes total sense. What else I would say is that, and I want your I want to discuss this a little bit. Have you seen that in the past, DSOs have relied too heavily on purchasing EBITDA to increase their total HoldCo value and kind of neglected to track same-store growth like they are now and the strength of the assets and the future strength of those potential assets than they used to?
I mean, early on in the evolution of the consolidation of any space where private equity is getting heavily involved, M&A is the name of the game, right? Because that you can grow the fastest acquiring EBITDA. But at some point, for one reason or the other, the marketplace is going to evolve to focus more on, great, you can acquire EBITDA, but do you actually make these assets better? Do you grow EBITDA post-acquisition? You combine that with a significant increase in interest rates and tightening of the capital markets over the last 24 months.
Yep.
And naturally, there's going to be a very bright light, shining on organic growth as opposed to acquisitory growth. I mean, almost anybody can go out and buy practices and stack EBITDA.
Yep.
But can you build a fully integrated DSO that provides operational efficiencies and financial efficiencies that leads to top line revenue growth and EBITDA growth over time at scale? And that's what everybody has been focused on over the past 24 months, whether it was forced upon them by their banks and their investors, or it was just the natural evolution of their company. I mean, you get to an inflection point where that should be your focus. Hey, we don't necessarily have to take our eye off the ball from an M&A perspective, but we've got to make sure that these businesses that we've acquired are performing, not just 6 months post-sale, but 3 years, 4 years, 5 years post-sale. And we have to eventually plan for the succession of the founder. And we're far enough along in the consolidation cycle that there's been plenty of DSOs that are being tested from that perspective as well. Doctors are at or nearing the end of their post-closing employment agreements, right? They were required to continue working for 3 years, 4 years, 5 years post-close. We're now about 7 years into the consolidation of our space. How have you performed from a succession planning standpoint, plugging and playing associates and backfilling the productivity of the founder, and then also backfilling the leadership of the founder if they completely step away? So DSOs have been tested across multiple facets over the past few years, and that's why the results are mixed. Some DSOs, they knew that this was all going to be important long term, and they built the business on a solid foundation, and they've evolved as the market evolved, and they were prepared for all of this and have performed remarkably well. Others were in the business of stacking as much EBITDA as possible and trying to flip it to the next investor before the macroeconomic environment changed, or they actually had to focus on the things that we're talking about. And a lot of them got caught with their pants down, and the market changed before they monetized the business. And now they've had to actually do the work that they weren't fully prepared to do. And that took a shift in mindset. But a lot of them were built on a strong foundation. A lot of them have righted the ship, and they've done what they need to do in order to realize those efficiencies and that organic growth at the practice level to allow the M&A engine, to be able to be turned back on. And there've been a handful of casualties. There've been a handful of them that didn't make it, and their equity as a result is worthless or currently owned by the bank, and it's TBD on what ultimately happens with those DSOs.
Wow. Okay. Very, very interesting. What have you seen as across the board performance metrics that are expected by the DSO once they have acquired an asset? Are you looking at, 5, 3, 5, 10% growth? What are they typically looking for? And then what are some remedies or consequences if the selling doc doesn't hit, kind of the mandated growth metrics?
I like the back end of that question a lot. So typically in these deals, there's some type of mechanism to create alignment and influence the seller to keep their foot on the gas, right? Whether that's some type of earnout paid to tied to maintaining revenue and or EBITDA. Earnouts used to be tied to revenue. However, more recently, we see them tied to profitability and EBITDA. It could be a joint venture equity component that naturally has alignment built into it. It could be some type of dilution provision that if the practice moves backwards, they claw back some of your equity, not your cash, but some of your equity. When we're navigating negotiations on deal structures with DSOs, we break earnouts kind of into two components. There may be a maintenance related earnout that's predicated upon you maintaining revenue and or EBITDA versus what we classify as an earn up predicated upon the growth of the business post sale. We consider earn ups gravy, right? If the business grows post sale, that's additional value and payout that you're going to achieve. We base all decisions predicated upon the current value of the business and any maintenance related earnouts, because we assume that so long as you're still involved in the business and keep your foot on the gas, and that you have a good partner that's also vested in operating and growing the business, or at least maintaining it post sale, that the practice is going to continue to perform. I'm not going to make an assumption that the practice is going to continue to grow, although I will say organic growth, big goal for and focus of DSOs in today's marketplace. If they have scale, they're likely going to be able to grow top line revenue and EBITDA post sale without doing much. I mean, if you're a PPO focused practice and you partner with a DSO that's got significant size and scale to it, you're likely going to see a significant lift on your PPO reimbursements almost overnight. That alone is going to lead to significant growth. But most DSOs are eyeing, from their internal perspective, a 5 to 7% year over year top line revenue growth and EBITDA growth. But again, we don't look at valuation and deal structure through the lens of requiring our client to grow the practice. That would only be an upside earn up scenario where our client can earn additional value predicated upon post-closing growth. And when you're working with somebody that's seeing good year over year growth and they feel like they're pulling the trigger on the sale of their practice maybe a little prematurely, and there's still a lot of meat on the bone from a growth perspective, that's where the JV equity component and or an upside earn up component come into play, because we want to make sure that our client's able to participate in the future growth of the business via additional cash payouts, larger EBITDA distributions, or an increase in the remaining equity value of the business.
Do you see most deals have some sort of an earn up component in there?
A lot of them do. Some of it's going to depend on deal structure itself. Look, if I'm a HoldCo DSO, I'm probably going to want to have some type of earn-out provision, some type of holdback provision predicated upon revenue and EBITDA maintenance. I'm probably also going to want to have some type of earn-up provision to incentivize my doctor partner to grow the business post-sale.
Yep.
Outside of their incremental contribution to the value of the HoldCo stock through that growth. Does that make sense?
Yeah, totally. Okay, great answers. I really, really enjoyed kind of digesting what you're putting down there. What are some of the things that you see people doing wrong as they enter this transitionary phase? And you said, mid 40s to late 40s. I've seen a big groundswell of late 30s to mid 40s people going to market within my group. And what we're always typically talking about is, okay, what is the cash windfall going to be post-tax, post-debt, and what do you plan on doing with that? How are you going to put that windfall to work in order to offset some of the personal take-home income that you are going to be decreasing without 100% of your EBITDA coming in? So those are some of the just back of napkin calculations that we do with younger docs to make sure that, it's sustainable and they can live within that new income level. So what are some of the things that you see as people are preparing to transition that they're not doing correctly or insufficiently, or they hadn't thought of?
I think people are being more prudent about these decisions today than maybe they were, 3, 4, 5 years ago. But I mean, we still see some doctors taking a very casual approach to evaluating if it makes sense to sell and when.
Mm-hmm.
And you've got to go through all those financial exercises to make sure that economically speaking, the deal makes sense for you. And the younger you are, I would say the more delicate that conversation is and the more the why matters. Because the longer the runway to exiting the business, you've got to evaluate, monetizing the business today or waiting and monetizing it later, whether that's 5 years, 7 years, 10 years down the road. It's a little less sensitive as you get closer to exiting the business. The shorter the runway to exit, the more compelling it is to monetize the business and go the DSO route, especially if it's going to fetch a significant premium compared to the selling to a private buyer.
Mm-hmm.
So I think most importantly, you need to start having these conversations early. And you need to do it with somebody that can give you an objective viewpoint on your options,
mm-hmm.
so that you fully understand all the options available to you. And anytime somebody starts a conversation with us, it's like, look, you got several options. We don't run our business in a manner that, we're a hammer and everything's a nail. And
mm-hmm.
anybody that calls, we're trying to convince to go to the DSO marketplace to get from an initial conversation to a commission as soon as possible. And unfortunately, I feel like that's how some of our colleagues in the space operate their business. The reality is that you always have multiple options. You can do nothing. Just keep your head down and keep doing what you're doing.
Mm-hmm.
You can sell to a private buyer or you can sell to a DSO. And then the timing consideration is indefinite depending upon your age. So you need to get educated early and often regarding what is your EBITDA, what is your business worth, private buyer versus DSO, what are the pros and cons of each of those options? And then what is the right time to pursue whatever option you think is the best fit for you? So in order to do so in a prudent way, you got to have good advisors at the table, right? You got to have your financial advisor. You got to have your CPA. You need a strong sell-side advisor that can give you that objective guidance. Also, planning ahead allows you to prepare for an eventual transition and reverse engineer whatever outcome you want to achieve, right? So we get involved in these conversations oftentimes 2 years out, 3 years out, 5 years out. Let's take a look at the business today. Let's identify the strengths and weaknesses of the business. Let's talk about your runway to monetizing the business and what needs to happen between now and then to reverse engineer the outcome you ultimately want to achieve. We have seen, some potential sellers hold off on selling, even though they're within a 5 to 7 year window of exiting the practice. And age matters. You're going to see a lot more demand and higher multiples, higher valuations for a practice owner that's in their 40s comparative to a practice owner that's in their 50s comparative to a practice owner that are in their 60s.
Interesting.
And we sometimes have conversations with clients that are 63 years old, sitting on a practice with $7 million in top line revenue. They've probably outkicked their coverage from the perspective of selling to a private buyer. It's not a matter of if they sell to a DSO, it's a matter of when. And they're already in the window where I wish they would have pulled the trigger 2 years ago.
Yeah.
Because age matters. Even if the practice isn't dependent upon you from a production and chairside standpoint, DSOs know that founder turnover is kind of their Achilles heel. They want the founder there as long as they can keep them there. And they want to create that alignment through structure to incentivize them to keep their foot on the gas. But if you're over the age of 55 and you have top line revenue, let's call it over 3 million, you need to be planning today as to what your exit's going to look like, because the private buyer marketplace does not look fondly on large multi-site, multi-doctor practices. They're hard to monetize to private buyers. And, we hear these talking heads say, well, that's not true. You can sell minority equity interests to several associates. That can be done, but man, that's a lot of moving parts and a lot of people involved. We do those deals, but they are infinitely more complicated than going the DSO route, and they're typically not as lucrative.
Yeah, because the valuation is based on a doctor-to-doctor sale versus a multiple of EBITDA valuation.
Exactly. And what we see time and time again is you might be able to liquidate 20, 40, 60% of the practice, but what happens when you're ready to step away and liquidate the remainder of the equity in the practice? That can be a real problem. We see those problems come to fruition quite frequently in today's environment, where the doctor decided to forego the DSO affiliation or private equity partnership. They decided to sell internally to multiple associates. They've monetized a piece of the equity, but now they're ready to monetize the lion's share of the equity and create that eventual succession plan. And the minority partners now have all the leverage to negotiate a really favorable outcome on the back end on that remaining, 50, 40, 50, 60% of equity. So it's not as easy as it may seem. Once you cross that $3 million mark, private buyer demand drops off a cliff. Those deals are harder to finance. It's harder to find a buyer that's got the confidence, the skill set, and just the money and the aversion to risk to buy a practice of that nature. And it does the opposite in the DSO world, right? Buyer demand ramps up, valuations ramp up. So if you are 55 years old and you have or older, and you have a practice of that caliber, of that size, you need to start planning today. You need to start having those conversations regarding if and when you're going to sell the business and how you're going to sell it.
It's a great answer. I want to take that same question and pose it at a different phase of a practice owner's career, right? So if we're seeing 38 to 42-year-olds be a major tranche of sellers right now, that's just in my own anecdotal experience in the practices that I work with, maybe 38 to 45. So age isn't as much of a factor in being kind of a factor that's going to deteriorate the value of the practice from a private equity standpoint. But what are some of the risks of waiting too long if now is the current environment and there's, an unknown environment in the future where consolidation could be at a greater clip? There could be a decrease in multiples because there's more practices on the market, or whatever the kind of market conditions are at the point. What are some of the risks of waiting too long? If bird in hand right now, debt is under control. You've peaked your EBITDA. Things are running very, very smoothly. And you say, you know what, I'm going to try to get an extra, $100,000 or $200,000 in EBITDA before I put this thing on the market.
I love this question because we're going to start talking about where this is all headed and what the next 5 to 10 years might look like. And obviously, if you're on the younger side and have a longer runway to exiting the business, you've got to think out that long regarding, if I wait, is this opportunity still going to be available to me? And if so, what is it going to look like at that point in time? And we're kind of mid-consolidation at this point. We will hit a tipping point at some point where valuations are going to decline. And I get into these interesting conversations, conceptually speaking, about what happens when we hit that tipping point, when a lot of the quality assets that private equity and DSOs would want to acquire have been sold. And now there's a limited amount of inventory available to buy. A couple of things are going to happen. One, new private equity investors are not going to look to start DSO platforms in an environment where we're so consolidated that they don't feel like there's enough growth runway from an M&A perspective to create the type of arbitrage they want to create on the back end when they go to recap. They'll go to some other industry that's freshly being consolidated where there's so much blue sky left, where they know they can position themselves for multiple recap events over a 10 to 15 year window. So you'll see less new private equity money coming into the space looking to acquire platforms and build a DSO once we reach that consolidation tipping point. We're probably, let's say 5 years away from getting there.
Really? That soon? Wow.
5 to 7, I think.
Okay.
To where the market starts to evolve in the next iteration. I think we're kind of in the new normal, post interest rates increasing, post, the capital markets being tightened, that I think will prevail for the next 3 to 5 years. But yeah, at some point, we're going to reach that tipping point where you're not going to see a ton of new platforms get formed. Whereas we've seen a tremendous amount of new platforms be formed over the past 7 years. Basic economics tells you that, supply and demand. If the supply of practices go down, but demand is relatively consistent, you would think that valuations will increase. Mm-hmm. However, it actually functions in the opposite manner in the private equity world. Here's why. Once you reach the point of consolidation where there's less assets to acquire, the only way to create arbitrage, to create gain, is to buy the assets that are left for lower valuations. The reason that DSOs have been able to create such value and great back-end outcomes, return on cash at recap over the past decade, is because they've been able to grow extremely rapidly via M&A, via acquisitions, via stacking EBITDA. But once a lot of the high quality assets have been acquired and there's a limited number of assets to buy, the only way you create a similar return on your capital is to pay less for the assets you are acquiring.
I see.
So that will eventually happen. Again, probably 5 to 7 years away from hitting that tipping point. But if you're a seller today, you have to think about, you at least want to get to one lucrative recap event, and you'd prefer for that recap to happen before you get to that consolidation tipping point, right? So you've got to think about not just the first bite of the apple, but the second and potentially the third bite of the apple, and realize that at some point, once we hit that consolidation tipping point, these DSOs move more into a long-term holding pattern where recap cycles are prolonged. They go from 5 years up to 10 or 15 years, and return on investment is muted to some degree. Rather than seeing a 3x return on investment over a 5-year window, you might see a 3x return on investment over a 10 or 15-year window. So you just need to think about, how does this play out from a long-term perspective? Because if you're a seller today and you've still got a 10 or 15-year runway to exiting dentistry, you're going to be there for all of what I'm talking about. And look, nobody has a crystal ball. I don't know when we get to that tipping point, but at some point we will get there. And that's when you're going to start to see, consolidation among the consolidators, some of the larger DSOs partnering with or buying up some of the smaller DSOs. That's where you're going to see some general dentistry platforms acquire or merge with some of the specialty platforms. I think we're still, 5 to 7 years away from that happening in a massive way. But you've already seen recently, a couple of large DSOs swallow a couple of smaller players regionally. And I think you're going to see more of that on a go-forward basis.
Really great answer. I love the way you wrote that down. So you mentioned recap events, and this is where we lose some people, not necessarily because of the definition of a recap, but just because there's so many talking heads out there that just say, from CPAs to well, mostly CPAs that say recaps do not exist. Look at the historical kind of performance of DSOs trying to recap. They've struggled over the last couple of years, and the recaps that have happened had been less than stellar, or basically, in a lot of cases, they seem like a refinance. In a lot of ways, where they'll take on more debt to continue to buy assets at a high interest rate, and they're disguising that as some sort of a recap event. So, what do you say to the naysayers? And I talk to people all the time that say, I'm not going to sell to a private equity backed DSO because that 70% that they're promising me is probably the last money that I'll ever see from this. And that 30% that's supposed to add some multiple of MOIC or whatever, will not happen. And here's some historical facts to prove my point. So 70% of what they're evaluating at is basically the same as I could get to a doctor. So I'm going to sell to a doctor. What would you say to those people?
I love this topic. So what we often hear those talking heads saying simultaneously is that private equity is making a fortune on the backs of dentists. And don't buy into the value of the stock. It's worthless. How can those two things coexist at the same time?
Yeah.
Private equity is either making a boatload of money by investing in dental practices, or they're losing their ass and the stock is worthless.
Both things cannot be true simultaneously.
Absolutely. Yet you see these talking heads say both of those things all the time. Look, a broken watch is still right twice a day, right? Mm-hmm. It kind of reminds me of these talking heads with the stock market that are saying, a crash is coming tomorrow. Well, a crash will eventually come. But what would have happened if you sold all of your stock expecting that crash to happen tomorrow and it takes 5 years to get there? I think it's really, really convenient for a lot of these talking heads to say, I told you so. The stock is worthless because of what we've seen happen in the marketplace over the past couple of years, which is a product of the macroeconomic environment that is completely outside of private equity's control when it comes to interest rates in the capital markets. However, back in 21, 22, front half of 23, had you been looking back at all the recaps that occurred in the previous 3 to 5 year window, I could argue the opposite. Mm-hmm. You were seeing 3 to 5x return on invested capital on a regular basis. Recaps cycles have definitely been prolonged. Recap returns have absolutely been muted over the past 24 to 36 months. That goes without saying, but that doesn't mean that they're right. It just means that they can finally say, I told you so, for a short period of time before the market evolves again. And it will, and it's already starting to evolve. We're now entering a much more optimistic, much more favorable environment with declining interest rates. You're going to see the capital markets open back up over the next 12 months. You're going to see M&A activity pick up, not just across dentistry, but all private equity-backed industries over the next 12 to 24 months. And you're going to see some lucrative recaps occur. What has happened over the past 24 to 36 months is not necessarily an indication of what happens over the next 24 to 36 months. I don't think we're ever going back to where we were because the macroeconomic environment's never going back to where we were. We're not going to have this artificial, zero interest rate environment and crazy capital markets that are just wide open where money was loose and cheap. It could take our lifetime to create those market conditions again. But we're also not going to be in the type of capital environment we've been over the past 24 to 36 months on a go-forward basis.
Moving forward, yeah.
I think we're going to be in a lot better environment. I think you're going to see some favorable recaps, some real recaps at favorable returns on equity. And then, I think some of the other results are going to be more mixed, right? Because we're now mid-consolidation cycle, we're kind of seeing like who are the strong players and who are the weak players, who was built on a strong foundation and who was not. A big part of our job is vetting these DSOs and making sure that our clients don't end up with, one of the players that was built on a weak foundation and it's going to go to zero.
Yeah.
But I'm also not going to promise every client that they're going to get a 3 to 5x return on invested capital. The goal is to get a reasonable return on invested capital. And even if it's a 2x return over 5 years, that's likely going to beat anywhere else that you could put your money.
Yeah.
In combination with the de-risking that occurs by taking chips off the table up front and diversifying your wealth, I think that that's a great outcome for the vast majority of our clients. That said, you should not make decisions based on 5 to 10x return on invested capital over a 5 to 10 year window. A lot of DSOs will put LOIs in front of you with crazy stock projections. We're going to hit 3 recaps over the next 15 years, and you're going to see a 15x return on equity. Everybody's a seller at a 15x return on equity. I would buy equity in that DSO tomorrow if given the opportunity, but the reality is likely somewhere much more conservative than that outcome. We've also seen some crazy DSO HoldCo models where the doctor receives very little cash at close, maybe 20, 30% cash at close, and they're doing a 70 to 80% HoldCo equity roll because they're enamored by the promise of the return on that equity. That is a crap deal. Do not do that deal. If the cash at close is not at least 50% or higher, don't walk away, run away. And the reason we've seen that recently is there's been a lot of these like roll-up concepts where they were trying to, duct tape together 50 practices and sell them to private equity for an elevated multiple compared to what they're worth on their own. And they've realized that that doesn't work. So they've pivoted to forming an actual DSO, but they don't have any capital.
Right.
And they are basically transferring all the risk to the doctor and giving them very little cash at close and putting everything on a HoldCo equity roll. That's a poison pill for your practice. Look, these deals do have some risk, but that is outsized risk. If you're being asked to do a 60, 70, 80% HoldCo equity roll, that's a bad deal. Don't do those deals. And that's where when you hear these talking heads talk negatively about DSO deals, those are the deals that I can agree with them on. Stay as far away from those deals as possible. Don't make decisions on some type of crazy expectation on the return on equity. And that's, where we do a lot of financial modeling with our clients pre-market to show them, hey, here's what your cash at close looks like. We got to adjust that for debt and taxes, obviously. Here's what your income's going to look like annually along the way. We've got to compare that to your annual burn rate. And here's what it could look like with a modest return on equity at recap, not a unicorn return. And we're not looking at multiple recap events so that our clients can make prudent decisions about their future, rather than promising them the moon and them being upset with us, 3-5 years post sale. All we have is our reputation in this market, and it's incredibly important to me. And that's why we advise clients the way we do.
Yeah. Yeah. That's good stuff. And we've all seen, these unrealistic claims at the closing table, either from a broker or from a representative of the DSO that's trying to get a doctor to sell to them. And most of it comes down to just outlandish kind of promises of what recap will look like, 3 to 5 times being conservative in, a 2 to 3 year period of time. It's just probably not going to happen. I mean, that might have happened in the past, but it's probably not going to happen. And then, you get the doctor to sign, you have the asset under your umbrella now, but now you have a disenchanted doctor in 2 years and then 3 years and then 5 years when they finally get some percentage of that. And then it just ends up being toxic for the overall organization. So it is kind of a short-sighted land grab when you're over-promising probably, I'm speaking to DSO owners or brokers here. Like, it's better to grow that DSO with a little bit more care and conservative projections, and to keep everybody happy because the expectations were not, blown out of the park.
Yeah, here's how I look at the world. Most of the time on almost any issue, the people at the extremes are full of shit, right? Like the people that are saying that the DSO equity is worthless and you should never sell your practice to a DSO, that's not an objective viewpoint. It's a biased viewpoint and it's ill-informed. The people that are saying that you're going to get a 20x return on your invested capital on the HoldCo stock component, that's highly unlikely. The truth is likely somewhere in the middle, at a more modest outcome. It's no different in politics or anything else. If you're that far left or that far right, I think you're probably batshit crazy.
Yeah.
The smart people are somewhere in the middle.
Yep.
And that's why it just pains me when I see these talking heads just hold to a position with such firmness that's not predicated upon fact. It's predicated upon bias. And that's where I think doctors have to look at, where are you getting your information from? And why would this particular person be biased? When you talk about, whether it's, I don't want to pick on CPAs, but whether it's CPAs or consultants, businesses that are predicated upon maintaining a large client base over time, you have to understand that their client base is under siege by DSOs poaching their clients. They're buying their practices, and then they're doing all of the accounting and consulting in-house. Therefore, that advisor loses a client. Of course, they're going to be biased. They don't want you to sell to a DSO because they lose a client if you do. So you just have to evaluate where your information is coming from and understanding that most people are selling something or have some type of bias, and you need to make sure that you don't make decisions predicated upon their bias.
Yep. Yeah. What's their underlying motivation? It's very important to be able to identify what that is. And you're right. I mean, in my line of business, every practice that sells and transitions out is one less client for me. But my ultimate goal is to get people to a successful transition at some point in their life cycle. I mean, that is an inevitability about consulting. I would never tell anybody out there that DSOs aren't worth exploring, and that they're all crooks, because it's frankly just not true. I think that in most cases, for practices over a certain top line level and EBITDA level, you've priced yourself out of the doctor-to-doctor market, and you're going to do much, much better selling to a private equity-backed DSO. Now is your homework time. Now it's your time to do the due diligence. Reach out to somebody like you, Brannon, to be an advocate, to fill in the space of the information and the wisdom that they do not have in this particular area, and talk to somebody that is on your side that does this for a living. So if they're unwilling to do that, then maybe doctor-to-doctor sale is the best way to go. But if they are willing to educate themselves and get an advocate, then I mean, at least it'll offer a lot more potential options.
And that's where I love our position in the marketplace. The legacy business that I bought 15 years ago was a traditional practice brokerage firm focused on doctor-to-doctor, traditional practice sales. And that business is still alive and well. A lot of people hear me on podcasts and webinars and at conferences talk a lot about the DSO affiliation topic. And that's because I think that's where a lot of the noise is. That's where a lot of the misinformation is. A lot of people don't know that we are about 50-50 every year from a transactional perspective. About 50% of the deals we work are doctor-to-doctor traditional practice sales all over the country.
Interesting.
And about 50% of the deals we do are DSO and private equity affiliations. Now, obviously, the volume on the DSO and private equity side is larger, because on average, those deals are 10 times larger than a doctor-to-doctor deal. But from a transactional perspective, we're almost an equal balance. So I love coming from that perspective because it allows us to be objective. Like, I don't care. You're a client for me potentially either way, whether you go the DSO route or go the private buyer route. I don't care. Let's unpack all the options, see what makes the most sense for you. And then when the appropriate time comes, we'll make sure you crush it. So that's kind of where we start all these initial conversations, is just do a discovery call, have a casual, confidential 30-minute conversation. Let's learn a little bit about your why, learn a little bit about your practice, and see if it makes sense to do a deep dive, do a EBIT analysis, do evaluation, and unpack what's your practice worth private buyer, what's it worth DSO, what are the pros and cons of each of those options, and get you educated, whether it's time to sell now or we're talking about 3 to 5 years from now. We love having those conversations, love getting involved early. So anybody listening to the podcast, I would encourage you to reach out to me. I always give out my cell phone number every time, Mark. I think people think I'm crazy, but this is all I do all day long is, talk to successful practice owners and try to get to know them and understand what makes them tick and when's the appropriate time and what's the appropriate path to monetize your business. So you can text me, call me, 512-660-8505. You can shoot me an email. It's Brannon, BRANNON at dentaltransitions.com. And feel free to check out the website, dentaltransitions.com. A lot of conversations like this, podcasts, webinars, articles. We're all about education.
Good one, dude. All right, man. Well, there's even more that I wanted to ask you, but we're already over an hour here. So we'll stick a pin in it and talk about what are some of the things that you sometimes have to advise your clients to do in order to increase significantly the transition price, or affect the valuations within the dental practice to make them maybe go from less attractive to both sets of buyers to more attractive. And what are some of the kind of subtle dials and levers they can push and pull in order to do that? You and I could talk a whole hour about that as well. So great stuff, man. Thank you so much for continuing to educate the audience, and best of luck for this year. Let's make 2026 even better than 2025.
Yeah, always good to see you, and look forward to next episode. We'll touch on all that. What to do to maximize the outcome when you get there.
Sounds good, brother. All right, ladies and gentlemen, the CEO and principal at McLerran and Associates, Brannon Moncrief.